Good afternoon, everyone. Thank you for your patience. As the slide says, it's self-explanatory. Please mute yourself until the Q&A session, and please rename yourself if you did not register and use the link in the WhatsApp group. Again, good afternoon and welcome to the Hawksbay Group and Hawksbay Self-Storage webinar. A little bit about Hawksbay very quickly. Hawksbay Group is a boutique investment firm and sponsor of Hawksbay Self-Storage, focusing on niche, fragmented real estate sectors. We drive alpha through asset repositioning, operational improvements, and smart structuring. Our senior team has 25 years of experience and 100 billion in transactions. The self-storage vertical is led by Raheem Amer and Imran Ahmed, supported by a dedicated team of real estate and capital markets professionals. A little bit about our co-founders. Raheem Amer is one of our co-founders and CEO of Hawksbay Self-Storage, overseeing acquisitions, operations, and asset management. He brings 24 years of self-storage experience and has managed over 4 billion in transactions. His background includes senior leadership roles at My Place Self-Storage, Mini Mall Self-Storage, Devon Self-Storage, and Extra Space Self-Storage. Imran Ahmed is the second co-founder of Hawksbay Self-Storage and leads Hawksbay Group, overseeing strategy and capital markets. He brings nearly 30 years of global real estate experience with prior roles at PIMCO, CBRE, KPMG, Deutsche Bank, and Reneri Partners. He holds graduate degrees from Harvard and MIT and an undergraduate degree from Cornell. So let's do a deep dive into this. I'm going to start off with you, Raheem. With a lot of real estate sectors suffering in light of overbuilding in the last cycle and the rise in interest rate, why do you think this is a good time to consider investing in self-storage?
Well, thank you for the question, Shumesa. And again, thank you everybody for jumping on a call on a middle of a Sunday morning here. I appreciate everybody joining. And to answer your question, Shumesa, again, even with higher rates, self-storage continues to outperform mainly because it's a need-based business. People downsize, they remodel, they go through divorces, they start businesses, they store inventory regardless of what the market cycle is currently doing. And at the same time, new development has slowed dramatically due to construction cost, lender pullbacks, and tighter zoning. And all this means for us is that existing well-operated facilities are positioned to grow. And for long-term investors that are cautious for market yields, better entry points and stronger forward returns are set up for success in the self-storage industry currently. And that's what we've been seeing for the last 2 years.
Thank you, Raheem. I think that was helpful for the people that are listening in. And please do type in your questions. We're going to come to them in the next 18 to 17 minutes. Imran, question. What are some of the factors and trends affecting the outlook for the sector?
Absolutely, Chimesa, and thank you for that question and welcome everybody. So there are five key trends that are worth highlighting when it comes to looking at self-storage. The first and foremost is sort of the slowdown in new supply. Number two is sort of there are a number of technology tools that are now available that allow for improved revenue management. And then there's the impact of digital leasing, which, now with everything from AI to other digital means that are available on the internet. And then there's the continued rise of small business storage needs that continue to fuel demand. And at the end of the day, it's really about, a kind of more disciplined operators that are more professional in their management, sort of replacing older legacy management.
Thank you for that, Imran. So then let's just do a deep dive further into this. Are the cash flows and the returns for self-storage recession-proof? Because for everybody who's here and everybody who's following the news, that is a very relevant question right now.
Yeah, no, that's a very good question and a very good point to make because at the end of the day, regardless of how much we would like, there is no asset class that's completely recession-proof. And I think what we can say about self-storage is that it is recession resilient more so than recession proof. And historical data has shown that during downturns, demand softens a lot less in storage than it does in other real estate sectors for obvious reasons. And some of the things that Raheem highlighted initially in his opening remarks. And then, when it comes to people needing storage during life transitions and the fact that most of the tenants view storage as an essential service as opposed to a luxury item, that sort of drives the fact that the demand tends to be sort of recession resilient. And at the end of the day, small unit sizes and low monthly rents make the tenants less sensitive to economic pressure. So those are the things that factor into that resilience.
Well, thank you for that, Imran. When you talk about tenants, Raheem, who are these tenants? Who uses self-storage and what is the typical customer profile?
Our customer base is very broad. The largest group of people are people that are moving homes, they're dealing with life changes. That's one of the unique things about self-storage is that nobody ever gets up and goes, you know what, I got 3 hours to kill today, let me go look at self-storage. There's usually some kind of a life change that has happened in your life. You've gone through a divorce, displacement, dislocation. Something has happened in your life that has caused this change. And that's one of the things is doesn't matter if the economy is going through a recession or an inflation, everybody always needs self-storage. And that's why across the board in US, the average self-storage facility is 90% occupied.
Oh, wow. Okay, so then can you speak to the broader national demographic trends that affect the self-storage sector?
I'd say I narrow it down to two factors. The first one is the increase in adoption.
Hmm.
We've seen over the course of the last 15 years, adoption has increased from 9% to 11%. There's still not, 89% of the population that has not used self-storage, and then increase in population. As we continue to grow and as we continue to expand, you'll continue to see more and more people try start using self-storage.
Thank you for that, Raheem. So, Imran, from your, obviously your extensive background and the financial perspective that you bring, in terms of like the financial performance perspective, how do you think self-storage stacks up relative to other property types?
Yeah, no, absolutely. And I think this is a very important consideration that very few people sort of factor in to their analysis when they're looking to invest in real estate. And I think self-storage, as you can see from this little diagram at the bottom of the slide, outperforms every other sector with the amount of green that you see in the top row. Whether it's inflation capture, other income collections, capex, turnover costs, I think, and operating margins. The only sort of category that it doesn't outperform, say something like multifamily, is financing rates. And I think what we're already seeing in the markets, and particularly in the capital markets where I spend a lot of my time, is that the financing rates for self-storage are now becoming almost as competitive as what the available financing is for multifamily. So all in all, when you think about self-storage relative to all the other sort of major food groups in real estate, self-storage outperforms by far.
Thank you for that perspective. I think that was very helpful. Raheem, what are some of the sector's unique features and how has it historically performed relative to other types of real estate? I know that Imran touched a little bit on that, but if you could just, sort of like talk us through this a little more.
Yeah, if you look at the stock market, the self-storage stocks have consistently been the highest performing real estate stocks based on the REITs data. And it has strong margins, low maintenance cost, flexible pricing power, and I would say low tenant turnover cost. And I can go through that in detail if you like.
Yes, I would actually like that because, let's say like myself and the other people that are participating in the webinar today, I would be interested in knowing why this is a compelling investment opportunity today compared with the other options that I have available or that other people on this call have available to them.
Yeah, so I'll give you three examples, right?
Sure.
So let's take for one is if you have an investment property, how often Shumesa, do you give a tenant a rate increase?
Oh my gosh. Probably if you're fortunate once in a year.
Once in a year. What do you think the average is? Looking at the last 5 years, the trend has been about anywhere about a 5% average rent increase on a tenant. In self-storage, because we are a month-to-month lease, We
Mm-hmm.
give two rate increases on a yearly basis, and
Mm-hmm.
our average comes out to about 13%. So 13, 13, you're giving 26% increase in revenue, or you're getting a 26% increase in revenue on a yearly basis. So in a matter of about 3 to 3.5 years, you're doubling the amount of revenue you're generating from your investment. So that's one of the reasons why self-storage continues to outperform. So that's number one. Number
Okay.
two, I think I told you low maintenance cost. When you have a tenant that leaves your apartment, what do you
Mm-hmm.
think you have to do?
Oh
You
my gosh, a massive, massive, massive overhaul.
okay.
If you're lucky, that is, if your
Correct.
tenant has left it in good condition.
Average cost, again, based on Pew Research, is that 8,000 to 10,000 is spent to remodel the apartment before you rent it to a new tenant, right? You have to repaint, recarpet, maybe fix up some appliances.
Mhm.
Anywhere from $8,000 to $10,000 is what's going to cost you. In self-storage, I walk in with a broom and a dustpan. 30 minutes later, I've cleaned up the storage, and I can rent that to the next customer. So it's a 30-minute labor investment
Mhm.
for me to turn it around and get it ready for the next tenant. So low maintenance cost. Number three is the um, eviction process. In a investment property, if
Mhm.
a tenant does not pay, what do you think you have to do,
I
Shmaisa?
don't want to think about it, Raheem. I
Okay.
do not want to think
You
about
have
it
to
because I
go
think
through a
everyone who's on this call, if they've ever had to deal with it,
yes.
100% do not even want to remember that.
Yes. So in the eviction process is you have to go through attorney fees, you have to go through legal, and while you're doing all of this, the tenant is not paying. So an average tenant takes about 6 months to evict.
Hmm.
So they have not paid you from 6 to maybe 8 months before you get to that stage and you get your unit back. And that's again anywhere from $8,000 to $10,000 in lost rent and also in legal fees. In
Thank you for
self
that. Sorry,
in
go ahead.
self-storage,
Hmm.
if somebody doesn't make two payments, they don't make a payment on day one,
Mm.
they don't make a payment on day 31. I start the auction process, and then on day 63, I auction their unit. We collect average about 40% of our debt, and then we are on day 65, we're renting that unit back to the next customer.
Those are
So
all three very compelling reasons.
So all three of those make self-storage a very unique opportunity and something that you can rest at home, with the surety that your investment is protected.
Very compelling reasons, Raheem. But another question, which obviously, like all of these questions are leading me to ask more questions, which I hope you guys will bear with. Imran, so while Raheem makes a very compelling case for this, why would I or any of the people in this webinar invest with Hawksbay as opposed to, in self-storage through public REITs or by any other means?
You're on mute.
Imran, I believe you're on mute.
Sorry about that.
That's it.
So yeah, no, that's a great question. And now that we've established some of the high-level attributes of the sector itself, uh, the case for self-storage, and your question is sort of a two-part question, right? First, why invest with Hawksbay, and then why not just kind of
Mhm.
invest with one of the other options that may out there the most be out there, which the most obvious one being the sort of public REITs. So when it
Right.
comes to why invest with Hawksbay, the platform and the professional itself bring the following things to the table. They have, as you identified earlier on, over 100 billion of transaction experience, over 6 billion of self-storage transaction experience. They have experience in terms of creating value throughout the chain of operations in the self-storage industry itself, and understand all the sort of top technological and operational complexities that go into creating value in self-storage, and have a deep understanding of the product itself. And then when it comes to investing with Hawksbay versus the REITs, I think the most important point to make is The REITs tend to be large, slow moving, and are focused on stable income as opposed to creating value and long-term value for the investors. And the way Hawksbay operates which is through speed and execution and in its execution and with precision, which means that we focus on hands-on management through digital marketing, optimized pricing, and operational improvements, which really make a difference in terms of the value that we create. The public REITs cannot operate with the same degree of effectiveness and with the same sort of precise methodologies that we employ. And our returns are actually tied to really the operating performance of the properties itself and the value that we create at the properties as opposed to being subject to stock market volatility. And that makes a huge difference. I mean, right now the stock market's on a high, but we all can recall 2 years ago it wasn't doing so well, and the REIT stocks were all sort of down in the doldrums.
Thank you for that. So it's your team, it's the efficiency and it's the speed with which you operate, which leads me to ask another question for you, Raheem. Self-storage is, a big market with all different kinds of products, from the multi-story climate-controlled, highly amenitized urban facilities to the drive-up sheds off the highway. Where does Hawksbay play and why?
All right. For you to understand that, you have to sort of understand the landscape of self-storage. And let me paint this picture for you. So there's about
Sure.
60,000 self-storage properties across the country currently, and only 18% are being run by REITs, professional operators. The
Hmm.
rest of them, 80+%, are being run by mom and pop owners that don't have sophisticated websites, don't have a revenue management system. They don't have a software system that keeps track of who's got a rate increase and who doesn't. And that's where we come in, is that there's so much opportunity out there to grab these properties, acquire these properties, and put in our operational infrastructure, um, put in some marketing, and help with the revenue management, and remove these legacy owners so they can go on to do something different. And there's a huge opportunity right now, and that's what we are continuing to do. So even over the course of the last 5 years, we've only seen that number increase. As I said, a professionally operated property is only about 18%, and that's moved maybe 2% in the last 5 years. So there's huge opportunity out there, and that's where Hawksbay is going to come in.
So I get that you've explained the opportunity landscape very well, but what are the specific things that Hawksbay would focus on or focuses on to improve the property level performance and deliver? And what are the levers at its disposal to
Okay.
generate returns and alpha, to use a financial term?
I can give you 7 levers that play into it. I would
Okay.
say number one would be a strong SEO and digital lead generation presence. That's what we're going to bring in, is create a website that drives leads to the property. And all that means is the more leads I have, the stronger I can move the rates and the faster I can increase the revenue of the property. Number two would be dynamic pricing and revenue management. That everybody gets a rate increase, not today I feel like Thomas should get a rate increase, and Thomas gets it and Joe does not. Everybody gets a rate increase on a regular basis. ECRI, existing customer rate optimization, would be the third one. Fourth one would be better tenant conversion and sales process. We want to make sure that doesn't matter where a customer is coming from, be it text, chat, website, email, driving from in front of the property, that they become a lead. That we give the customer the option of how they want to transact with us. And then we put in a high tech AI tech stack, with a camera system, with the CRM system, the customer rate management system, the customer interaction system. All of those are AI tracked, so we're able to gauge where the customer is in their life cycle. And I would say the last one would be operational discipline and accountability. We keep the pulse on where the property is and how fast we need to generate and how well we need to control the expenses of the property. So all seven of these truly drive Hawksbay to a whole different level.
Got it. But then to sort of like, to sort of piggyback off the same question, what is Hawksbay's approach, self-storage's approach to business? And if you had to list them, what are the unique things about it?
Discipline operations. I think I've already said that a couple
Yeah.
different times, right? So
Yeah.
discipline operations, data-driven decisions, and a local market understanding of how we need to move the lever so we get more leads coming into the property. I say all three of those drive us forward.
Got it. So consistency, accountability, and operational excellence would be the foundation. Thank you for giving us
That
that
would be it.
overview, Raheem and Imran. Imran, I'm going to jump right in and ask you this question then. How can people invest? How can we invest in self-storage through Hawksbay? And what does the fund offering look like?
Sure, absolutely. And, I'm going to sort of focus on the right side of this slide for this question because we've addressed a lot of what's on the left. Yeah, if you look at the right side of the slide, I mean, we offer three classes of shares, starting at 50,000, all with a preferred return of 8% to
Mhm.
the investors for the management actually participates in any kind of carried interest or anything like that. So you get your money back plus 8% before any of that. The investors can expect quarterly distributions beginning with the first full quarter after the fund is fully raised and deployed with a whole period of about 5 to 7 years. That's the
Mhm.
expected life of this investment vehicle. We're targeting 5, and hopefully we'll be able to get you your money back and your return prior to that. So we start thinking about exiting our investments and after we've created initial value through operational improvements in 3 to 5, starting around between years 3 and 5. We are targeting a return on top of what your investment of about 50 to 75% over that duration, which would imply a 1.75, between 1.5 and 1.75 equity multiple, and an IRR, sort of an annualized rate of return of about 15% on the
Okay.
money that you put into the fund.
Are,
Thank you.
are, is everybody able to see the slide? We're showing slide number 15 in front of us right now. I think
Yes.
there's a question. Okay, good.
Okay, I'm glad you jumped in and asked that question, Raheem, because I was going to ask otherwise. But look, Imran, I get that. And but if you could just simplify all of that for me specifically, let's assume if I were to invest 100,000, for example, in Class B shares, what would my return profile look like?
Sure. That's a good question, Shivesa, and we get asked that quite a bit. And I think this slide actually is meant to address that question specifically because, starting with, the closing of the fund, if you were put in $100,000, which, the pointer is at right now, you can expect sort of a quarterly distribution that will ramp up. Initially, it'll be sort of a low yield because we are making operational improvements to the properties, fixing them, whether it's physical capex or introducing new technology systems that will sort of eventually lead to a higher income down the road. So there's a ramp up process. So you're getting a low yield in the first 2 to 3 years.
Okay.
We expect to hit our stride by year 4. So you sort of the cash flow ramps up, and so that your yield on your investment is 7+%, and we sort of stabilize at around between 7 and 9%, 7.5 to 9%. That's kind of the time frame that we will be looking to exit the
Okay.
investment. At which point you can see what the sort of breakdown of your distributions will look like between current cash flow and, in this case, the specific example, which is based on obviously a transaction that we've underwritten and are very comfortable with the profile of, is your 20%, 29% of your cash flow, which is your profit, will come from basically current cash yield, sort of quarterly distributions, and about
Okay.
70-ish% will come from liquidation preference of capital appreciation on the back end.
Okay. Got it. Thank you for that. But just contextualize this for me. The self-storage investment opportunity. I mean, you guys have spoken about this, contextualizing self-storage as compared to real estate, property types, and the
খুব
but just if you
খুবই
could
তিনজন
sum it
তিনজনই
up.
খুবই ভালো বোঝানো। So একটা একটা মনে হয়
I think someone might. I'll repeat the question. I think someone had unmuted themselves. So Imran, you and Raheem have very effectively actually juxtaposed, self-storage investment opportunity, specifically Hawksbay self-storage, as compared to other real estate property types. But if you could just sum it up quickly for me before I move on to the next question, it would be, what is the performance of different available investment options?
Sure, absolutely. And it's a very good question. And I think this particular slide kind of illustrates that very effectively. And, the reason why we sort of put these two sort of charts, one chart and one sort of bar graph together side by side is one, basically demonstrate, how self-storage has performed sort of in the public markets, which is really a function of the underlying assets as well. When you compare self-storage relative to the other REITs that are out there in the other asset classes, and you can clearly see that self-storage has outperformed dramatically. And then that's the chart on the left with a lot less volatility, higher return, less volatility, less risk. So great asset class to be investing in, and that's looking at average returns over 30 years, which is a fantastic sort of benchmark. And then when you, on the right-hand side, you look at the expected performance of this fund, as we positioned it at around 15+% relative to what your other options are. And if you look at how the S&P or the Dow Jones Industrials or the Dow Jones REIT Index or even investing in treasuries has done historically over the last sort of 5 years, you can clearly see that the returns that we are targeting, which are very consistent with what has been delivered over the last 30 years. If you were to put the same amount of money in some of these alternative asset classes, you would have done much better, and we expect you will continue to do much better in self-storage. So graphically, I think this is a very effective representation of what we expect the performance to be relative to other asset classes and what historically has been borne out.
Thank you for that, Imran. That was quite detailed and I think very effective as a slide because we'll be sharing the slide deck with everybody who's on this call and who has registered. But at the end of the day, this is a great opportunity. You guys have clearly laid out the lay of the land, what the opportunities are, how an investment would pay out. But what I would want to know from both of you is, quite frankly, um, you know, you're both co-founders here. So tell us about your team, its credentials, and why are you and Raheem, and this question is for both of you, why are you and Raheem the right people to invest with here? Let's start with you, Imran.
Yeah, look, I mean, I think we made the case for the team's sort of collective experience, both in terms of real estate transactions and self-storage transactions specifically. And I think and their background in terms of the industry, whether it's capital markets, whether it's self-storage, or whether it's broader real estate familiarity across the board, I think that makes for a compelling case. And then as it relates to the specifics of the industry itself and our experience within self-storage, maybe I'll turn it over to Raheem.
Great, thank you. Raheem, what is it about you and Imran's credentials and team that lend itself to make yourselves the right people to invest with here? Because people matter.
Because we're not just investors, we're also the operators, right? So number one, we have a whole operations team that's going to be running these properties. We have a marketing team that's going to be driving leads to the property. We have an acquisition team that goes out and gets properties across the country. And then we have a revenue management team that optimizes the revenue at each one of these properties. So I think that's a unique feature is you're not just investing in Hawksbay and we're finding somebody else to run these properties. We are ourselves running these properties, and we have been doing that for the course of the last decade. So it's not a new venture, and we're going to be testing it on your dime. This is a true and tried product.
Thank
And
you.
again, we're not purists, we're passive or passive managers. We're active managers here, right? And then hands-on operators who have track record of driving results. That's I would say the most important factor about us. And then our experience gives us the insight to identify opportunities quickly and execute with confidence because we've been in multiple different properties across the country. I have bought and ran properties, I'd say about 1,000 properties over the course of the last decade from New York all the way to California,
Oh, wow. Thank you for that.
including Canada. So
Including Canada. Well, that's good to know. Thank you for that, both of you. And my final question would be for you, Imran, because I know that you have the background and the experience in this as well. Is this opportunity Sharia compliant and have the recognized scholars approved the structure?
Yeah, absolutely. It is. We are structuring the fund to be Sharia compliant, and it is based on a very sort of acknowledged and conventional structure, which is known as the Ijara structure. This slide demonstrates how the diagram that shows how we construct sort of the master lease Ijara structure and how we implement it and execute it with the individual property transactions. That does not mean that we are not using conventional financing. We are using conventional financing at the property level, but through sort of the Ijara structure, we're cleansing the income that the investors will receive and the liquidation preference that the investors will receive. And this is a structure that has been acknowledged by and has been blessed by very prominent and respected Sharia scholars and Sharia boards, both at City Islamic and Kuwait Finance House, which is one of the more conservative sort of financial institutions that involved with Islamic finance.
Great, thank you for that. And we will be sharing the deck with everybody on this call, so they're welcome to go through it and always get back to you with questions. But the QR code is going to be on the last slide, and we'll just pull that up. And in the meantime, we're going to go ahead, like we said, and start asking the questions that everybody wants the answers to. So let's start off with the first question. Just bear with me. Okay, are there tax deductions available for investors for this opportunity, depreciation, operating expenses, bonus depreciation, opportunity zones, etc.? Let's start off with the first part, and then I'll move on to the next one.
So maybe I'll take the initial part and
Okay. The tax deductions? Sure.
Yeah. So
Okay.
so opportunity. So let me sort of work backwards from opportunity zone. So opportunity zone depends on whether we're not targeting opportunity zone specifically. To the extent we come across opportunities that are compelling that are in opportunity zone, then we'll definitely avail ourselves of those type of deductions that may be available.
Okay.
As it relates to the other questions, yes, all the depreciation benefits, anything to the extent of bonus depreciation is available. There are segments of our cost segmentation initially that are eligible for bonus depreciation. We will definitely be availing ourselves of those, and we will be passing those benefits on to the investors. So the fund will be structured for that to be a pass through.
Okay, thank you for that. So, Raheem, I think that you could answer this question. Which geographic areas, cities are being targeted?
I would say, again, we're looking, because of our model, we can fit anywhere. We're not tied down to any particular geographic area. But if you're asking for specific of where we're targeting, I would say the Southern Belt. So if you take the US and you put a line right through the middle, so the Southern Belt would be anything below that. And that's mainly because that's where the population is going. People are moving from Chicago down to Dallas. People are moving from New York down to Florida. So that's what's creating some of that need for storage in those areas, and that's why we want to tap into that. So that would be the primary goal.
Got it. Thank you. One of our participants, Ahmed, has a question. By investing in this venture, will it be considered private equity or something else?
I guess I have to ask what the context is of that question. So it is a private market investment. It is sort of illiquid. So, you don't have public market liquidity in the sense that you can't exit that investment when you choose to. So in that means, in that regard, I guess the closest analogy is that it is equivalent of private equity. But if there's something more to that question, happy to address that as well.
Okay. Ahmed, if you have a follow-up question, just do put it in the chat and we'll come back to this for you. Khurram Raheem has a question. Number one, fund structure. Number two, NOL K1 will be passive, question mark, offset against ordinary or passive income.
Passive, that's something. So you will be issued K1s, and it's a typical sort of commingled fund structure for them. So if other than that, there'll be regular capital calls, depending on the acquisition pace, which we expect to be fairly quick given the robust pipeline that we have. This shouldn't be anything out of the ordinary here.
Great, thank you. Another question. What percentage of the total projected return is from net operating income versus property appreciation, respectively?
Yeah, so that was kind of the diagram that we showed you,
Page 16.
slide 16, which is,
Okay.
sort of roughly a 70-30 split.
Got it. Thank you. And then Mumit Habib has a question. Is there a debt involved? Is it Sharia compliant? I believe you did talk us through the Ijara structure, but if you could just, talk to this question.
Yeah, so it will be, there is conventional debt at the property level. We are using the Ijara structure to cleanse the income that comes through through the master lease. And, but if there are any specific questions about the structure itself or any literature that somebody would like, including, the discourse from various scholars, we are happy to share that.
Sure, thank you. Oves has a question. He's asking how much OPEX operating expenditure is being considered in calculating the return profile that you showed in the previous slides.
It'll be different per property. There'll be some properties we're going to go in and we're going to find that they have they have no camera system, they don't have a gate system, they don't have anything, and that would require a bigger investment. So each property is looked at it through that lens. And we only move forward on properties that we feel are going to hit the minimum threshold of the IRR returns that we're looking for.
Okay, and then Oves has a follow-up question to that, which says, as a percentage of collected rent.
Sorry?
Oves is saying, say, as a percentage of collected rent. I believe he's referring to his first question, which is the operational expenditure.
Yeah, I think that will change dramatically depending on the property we'll be going after. So there won't be one consistent measure that we could use. Now, for future expenditures, what we do have one model that we look at is about 35 cents a square foot is what we look at as continuous growth or reinvestment in the property.
Got it. And then Khurram has a follow-up question, out of which one I believe you have already answered, geographic distribution, but portfolio pipeline and timeline.
Yeah, we have a robust pipeline right now, anywhere from about 15 to 20 properties. There is a mix of single properties and also multi portfolio deals that are available. Unfortunately, again, our goal right now is to make sure that we collect the fund first, become active, so that way we can go after these deals at the turn of a dime here.
Got it. Thank you, Raheem. And Shakil, I think, has asked a similar question to mine, but in a different way. So Shakil says, let's say he invests 100K. Does this money get associated to a certain self-storage business property? And are then the returns, etc., are shared based on performance of that business? I think he's talking about allocation of, whatever he invests in, or does this go overall?
It's across the fund. So your exposure is to every property in the fund. So it's not, you're not investing in a specific property. You're investing in the aggregate pool of properties that will be held by the fund.
Yeah. And just to highlight the screen that or what Usman is sharing, I think there's two case studies 19 and slide 19, slide 20. This is what we had acquired in the past. So if anybody wants to do look through that and look at the research of how much we bought the property for and what the current evaluation of the property is, you can sort of have a good understanding and what are some of the IRR returns that we've had in the past.
Okay, Ahmed
And,
has
and
this.
actually, just to add to that point, I mean that's a very important point that Raheem makes because when you look at the three case studies that are in there, I mean, the return profile is anywhere from 16.5 to 25% returns. And that's what we would expect on individual properties that,
Okay.
not every property is going to deliver a 25 and not every property is going to be a 16. And that's why we, at a gross level, we'll blend to somewhere close to a 20 across the performance of the various properties. But, we want a diversified pool of assets that basically some may have lower risk characteristics, others may have a higher risk and higher return characteristics. But at the end of the day, we're providing the investors with the best risk adjusted return across geographies and across properties, the sense of diversification that kind of hedges your risk.
Okay. Another question from Ahmed, which is interesting, and it's the proposition he has. Why not a partnership with investors, remaining as silent partners? And the logic he's giving behind that is he's referring to slide 27, and he's saying that, as founders and operators, you're quite well shielded. And it does acknowledge that it is a growing and profitable business, but in order to protect his investment, he's asking if you would consider silent partners.
Silent partner, well, you're effectively a silent partner if you invest in the fund. So I'm not sure I quite understand the question.
He might be referring to GP partnership versus LP partnership.
Ahmed, could you type in and just
way I see this is because you talk about shares, right? You talk about stock, similar like a stock. So that's not a partnership. If I'm buying a shares of a certain company, I don't become really a partner.
No.
So I was wondering if there's an angle for partnership scenario
got it?
for seven figures investors, for example.
Aha. Okay. Thank you for your question, Ahmed.
I mean, I guess the short answer is you're investing in limited partnership interests. You're not investing in shares per se. We call them Class A interests or Class B interests or Class C shares, but they're actually limited partnership interests that you're actually acquiring in the fund itself that will own the properties. That being said, if depending on the magnitude of your investment, if you want other rights as it relates to the fund, I mean, we're open to having that conversation. So
Right.
you can always approach us.
Sure. I was going to suggest that, Emmett, you know what? I think that that's a very good question and a very pertinent question. We do have a WhatsApp chat group, and we do have a form that you could fill out. And I'm sure Imran and Raheem would be happy to set up a call with you, and you could take this, off the webinar at some point. Does that help?
I'll take it offline. Thank you.
Great. Thank you so much. And thank you for your question again. Kashif Sheikh says, what are some of the setbacks that you have had over the last decade when running self-storage? I believe, Raheem, you're best equipped to handle this. And if you could highlight one.
Yeah, there's been properties where we have underwrote aggressive rate increases and we've not been able to hit those numbers because the lead flow wasn't there. We couldn't generate enough leads coming in to offset the folks that might have potentially been leaving the property. So that would be the one risk. And going back to what Imran talked about with the three case studies that you saw in front of you on those in those slides is we've seen IR returns from 16% to 25%. My average has been about 22%, and as you can see, we're underwriting close to a 15%. So we're being very, very conservative, taking that into account that we don't have any risk and we don't underwrite at a very aggressive model.
Okay, and then Shaquille has a question. He asks, are you seeking investments only for buying new properties slash businesses?
Yes.
Okay. And then
Yeah,
I believe,
this is a new fund. Yeah, you're not going to be part of the current portfolio that I already have. So Yeah, go ahead.
Oh, thank you for clarifying that, Raheem. And I believe the conversation, Ahmed will set up a separate call with the two of you and take this offline. But he has another question. What percentage of the company do these shares represent on a fully diluted basis, including options, warrants, and convertibles? And what prior funding has been raised so far?
So you're not investing in the company, you're investing in the fund, and so the fund itself just holds this pool of assets. So there are no convertible, there are no warrants, there's nothing of that. It's a simple sort of carried interest structure where, with the, as we described the fund initially, with the sort of, the investors get their money back with the 8 pref. There's a promote and a carry structure which we've laid out on slide 15. And that's basically what the management team receives as part of the general partner. And there is no other dilution.
Great. Thank you for that, Imran. And I think you guys have done a pretty good job because we don't seem to have any more questions. But what I would recommend is if we can pull out that slide with the QR code where people can go ahead and fill out that form and join the WhatsApp group, that would be very helpful for everybody who is on this call right now. And let me also reiterate that once you've done that, we will be sharing the recording and you'll be able to view the slides. If you have any other questions, please do go ahead and ask us. We still have 9 minutes
Hey,
to go.
Usman, you want to go to the last
Sure.
slide,
Yeah,
please?
let's go to the last slide. There we go.
Oops, sorry. Sorry about that.
No, that's okay.
The slide right before this.
I think I stopped sharing, right?
Yeah,
Yeah.
you did.
Okay, sorry about that.
That's okay.
So if everybody wants to scan the QR code, and that's how you join the WhatsApp group. And then if you have any questions, Ahmed Bhai, anybody else that wants to ask us any particular questions, we can definitely set up one-on-ones or Zoom meetings to discuss any opportunity that you'd like to dive into.
But thank you.
There was one question I think we
Yeah.
missed that it was somebody with my same name, so I'm not sure who that was, but they were
Oh yeah,
asking about this.
Usman, yeah, I get
Yeah.
it. So 70/30, and for what part? Could you please clarify?
Oh, is that why you were on that slide
Right.
15?
Yeah, they're
Okay.
asking about the promote structure.
Oh, the 70, so the promotes. I'm sorry, are they talking about slide 16 with the 730, 70/30?
15.
Oh, 15.
Yeah, there you go. So the 70/30 IRR hurdle, I think that's what they're talking
Oh,
about.
they're saying so after you get your money back at an 8% return. So we're looking at Class B's, which Class B shares, which or Class B interests, which basically have the 70/30 split. After you get your money back plus an 8% return on capital over that period of time at the time of liquidation, which is, let's just assume 5 years, then 70% of the cash flow will go to the LP interest, and then 30% of the cash flow from the liquidation will go to the GP, which is the management company. So that's how the split works. And then that's up to a 15% hurdle. And at the 15% hurdle, after you've gotten your money back, plus a 15% return on an annualized basis, the split shifts to 60/40.
Got it. Thank you for
And
that.
we have a detailed model that we can, we're happy to walk somebody through and they can say exactly how the splits work at the appropriate.
Oh, this is a fantastic question, and I don't know why my name is appearing as Usman. I could answer that question for you. It's because whoever joined, who hadn't registered and joined this webinar through the link that Usman Hashmi had posted on the WhatsApp group is now named Usman. So I apologize. You can go ahead and either type in your name into the chat, or I could tell you how to change it by connecting on the 3 dots. But since go ahead and type your name because I've been referring to you as Usman for a very long time. While I thank Imran and Raheem and Usman for this fantastic webinar and this great presentation. And for all of you who've come in on a Sunday and asked these fantastic questions, I would recommend that if you're not part of the LinkedIn group, sorry, if you're not part of the WhatsApp group, go ahead and join it. And once you do, we're happy to answer any questions as always. And thank you again. Hope you have a wonderful rest of your day wherever you are, and try to stay warm.
Well, thank you, everyone. Thank you for joining. Appreciate it.
Thank you. Thank you all.
Thank you, Shumesa, for emceeing for us.
Finexa is always happy to help out whenever needed. Thank you.
Excellent.
Thank you. Thank you.
Have a wonderful rest of your day, everyone.
Thank you all.
I think there's a question of where the deck is going to be shared. It'll be shared inside the WhatsApp group, and the QR code on the screen gets you access to the group.
Great. Now everyone can get back to their families on a Sunday. Bye.
And I need to make more tea.
Yes, I would highly recommend that with the cold wave.
You were good regardless of the cold.
I didn't lose my voice yet, so.
Excellent.
So,
Thank you all.
All right.
Thank you for attending.
Khudafis.
Well,
yep.